Hi, everyone. Thanks for joining us. I'm Sonia Kaki. I'm an associate at Baker Avenue Wealth Management. I'm a member of the CFA Society of San Francisco and part of our Young Leaders Council. It is my pleasure to welcome you today to our 2026 Market Outlook webinar. Now, before I introduce our panelists, please know that you will be muted for this event. But if you have any questions, I encourage you to pop them into the Q&A box below, and we'll try to get to as many as we can at the end of the event. We've already had so many good questions come through, so I'm excited for that portion. Lastly, this event will be recorded and we'll be sharing the replay. Okay, time to introduce our speakers. I am joined today by three incredible speakers, all of them CFA charter holders and more, each of them having been in the industry since before the global financial crisis. So we're so lucky to have all of that experience with us today in this virtual space as we try and wrap our heads around how to think about the investment landscape for 2026. All right, I'm going to start by introducing King Lip. King is our chief strategist here at Baker Avenue. He leads our investment strategy work and is also a familiar face in the industry through his work on CNBC and his advisory roles with BlackRock and the S&P Dow Jones. Thanks so much for being here, King.
Great to be with you, Sonia.
Next, it's my pleasure to introduce Ken Fryer. Ken brings over 30 years of experience as an institutional investor, including serving as Chief Investment Officer at organizations like Disney, Hewlett Packard, and Stanford. Ken is now the Chief Investment Officer of Atlas Capital Advisors. Great to have you here, Ken.
Thank you.
And finally, introducing to you Steve Biggs. Steve is the Managing Director and Head of Alternative Investments at the Mather Group. Steve has spent his career across public and private markets and previously served as Chief Investment Officer at HC Financial. Thanks for joining us, Steve.
Thanks for having me.
Okay, let's start with the economy. On one hand, growth has been more resilient than many people anticipated, and the recession concerns of a couple of years ago just haven't materialized. But at the same time, we're hearing concerns over job growth. We're hearing about a K-shaped economy. So, Ken, I want to start with you. How are you thinking about the economy right now, and how does that flow through to how you're positioning portfolios?
Thanks, Sonia. Yeah, last year was really interesting from a economic projection perspective. At beginning of the year, I think real growth was expected at 3% plus, and then there was Liberation Day, and the highest tariffs in a century, and I was thinking, and I'm sure many were thinking about what happened with the Smoot-Hawley tariff hack. Maybe not everybody was thinking about that, but that was like this disastrous escalation of tariffs that happened in the 1930s. And so, like many people, I significantly ratcheted down expectations of economic growth. And as it turned out, the tariffs, although they are a lot higher, have not yet uh, uh, led to a decline in U.S. economic growth. In fact, I think that economic growth last year came out about what as was expected at the beginning of the year, despite everything that happened, the tariffs, the government shutdown, et cetera. A big assist there, of course, was this artificial intelligence investment boom. I'm sure we'll talk more about that now. I track a big set of economic data because, as we'll probably discuss more in this call, my kind of framework for estimating when stocks are due for a fall is A, stocks are expensive, and then B, the economy turns down. And right now we have A, but we don't have B. The economy is still steady. And so, people probably are thinking about, geez, these are scary price earnings ratios, et cetera. And people are looking at some signs of weakness in the economy, especially as you mentioned, the economic data, but the consumer is holding up, the investment is strong, and so on the whole, it looks uh, like half the economic data I track got worse in the last year, and half the economic data I track got better in the last year. So we're still there in the middle.
Thank you, Ken. Yeah, it definitely seems to be a bit confusing at the moment. King,
Mhm.
what are your signals telling you about the shape of the economy?
Yeah, I think I'm more in line with what Ken mentioned. It's quite amazing that we've had back-to-back quarters of economic growth, strong economic growth, I would argue. And currently, the fourth quarter GDP from the Atlanta Fed, it's called the GDP now. You can actually look that up. It's at above 5%. I kid you not. So the economic growth is there. The only thing that we're sort of concerned about is job growth is sort of anemic. And I think that's the reason why the Fed has been cutting rates. We think inflation is also moderating. If you went to fill up your car, you have noticed that gas prices are down quite a bit. I think interest rates are also accommodative. I'm sure we'll talk a little bit more about that. But I think the big thing that I think is not getting a lot of press recently is the tax policy that's been enacted is retroactive for 2025. That means that all of us that have paid taxes or are estimated in 2025, there's probably a good number of people who are going to get tax refunds this year, and the number is somewhere in the neighborhood of about 100 billion in potential tax refunds. So I think that's actually going to be stimulative for the economy this year.
Thank you, King. Yeah, all eyes on fiscal stimulus for this year for sure. Steve, alternatives is one of your many specialties, and not to hold you in just on alternatives, but I want to know, I mean, 2025 was a really challenging year for some alts. And
Mhm.
so I would like to know what your outlook is for 2026 from that perspective.
Yeah, I think it could be a positive year. I mean, I agree with King and I agree with Ken on the economic outlook. So, with the fiscal stimulus coming, yeah, stocks are expensive, but if markets continue to hold in strong, I think the biggest challenge private equity has had is the lack of exits. So, a more favorable interest rate environment, a more favorable public markets, you start to see some turnover in these private equity markets and some actual realizations, some return of capital. I think that it will be a big benefit public for private equity, so that you're not only seeing the marks where in theory the value of the companies are, you're actually realizing value. So I think that's a big positive there. Real estate is gone through, a very challenging period, probably the most challenging since the global financial crisis. We've had a number of negative returns, certainly not only office, but things that have typically been strong, like industrial and multifamily, have experienced some of this challenging markets. I think last year was seemed to be a bottoming and a slight recovery. I think as we see, uh, more favorable interest rates, that should help continue the recovery in real estate. There's still some challenges that job growth could put a damper on multifamily, and a lot of inventory. So it might be more of a geographically differentiated market. And then I think private credit is the big question. That's where everyone wants to know about. But I think there it's a much broader market than people think. So I guess private credit and direct lending would be the most concerning part of all that. But I'm not necessarily throwing in the towel, and realizing that both public and private credit markets are fairly expensive right now, at least in direct lending.
Thanks, Steve. I do want to pick up on that because I think a lot of people are looking at private credit and it's been in the news, not necessarily for the right reasons. We're thinking about Tricolor Holdings bankruptcy, we're thinking about the collapse of First Brands Group. So, you said you're concerned, but ultimately, is it much ado about nothing, or are you really looking at this with concern?
Yeah, I think a healthy dose of skepticism is always it was good, as far as not getting carried away in these. But I mean, if we look at what you're being compensated for the incremental risk, if we look at public markets, I mean, I think investment grade credit is 60 basis points above treasuries, and high yield is 3.5, both at kind of historic lows. We have seen some compression in direct lending, but not to that extent. It's still giving a pretty healthy premium over the risk-free rate. as you get to larger companies, that spread has compressed more, but you are talking about safer loans. If Tricolor and First Brands obviously have been in the news and has added to that concern. And I think we've seen some outflows from the asset class as a whole since then. But for the most case, those are more broadly syndicated loans to private credit, and it's fraud. There's always going to be fraud. Some of the conditions that are in place, a frothier market may encourage some of that, but you're not going to eliminate all cases of fraud. And I don't think that's a wide scale problem. I think, the risk to private credit, at least in direct lending, is more just your standard credit cycle. I mean, the vintages originally, you go back a couple of years ago, everyone was worried about higher interest rates and all these companies were going to, struggle with the higher interest rates now that their floating rate loan went up. We've gotten through that. We've got a new vintage year. So generally 3 to 5 year loan terms. So we've kind of come out of that. And now I guess the next risk would be a credit cycle. But, I think that would affect all parts of credit. And, as Ken and King mentioned, things look, as far as we know, pretty good for 2026. So I don't see a huge uptick in defaults by itself. So
Can I just throw in one thing though on private credit? Can you guys hear me?
Yes.
Yeah, so it's interesting to look at the business development companies. So they're doing direct lending, and so they're an analog of private credit, but they're publicly listed, so you can observe the price action. If you bought the business development company index at the beginning of last year, you would have thought, gosh, how can I go wrong? The yield on this is like 9 or 10%. But in fact, your total return between the beginning of last year and now is negative 4%, despite the yield. So the prices, and so, at the same time, S&P 500 is up 19%. So investors at least in BDCs, so analogous to private credit, have made no money in the last year, despite, as we said, the economy being okay. So maybe there's still some kind of residual markdown in that sector, given these cockroach concerns.
There's certainly flows out of the asset class. So you've seen that in the non-traded BDCs as well. The difference of the publicly traded BDC is you exit whenever you want. And as we know, when there's more sellers than buyers, the price of the security goes down if it's traded on public markets. I mean, we've seen Cliffwater is the largest, right? They had 5.3% redemption requests last quarter, so exceeding the cap. But the bright spot about these non-traded BDCs, at least in the direct lending space, is the liquidity. This is a private market where the liquidity of the underlying asset is greater than the liquidity of the wrapper. So unlike something like private equity, where you hear more concerns about, you have 30% of the loans maturing, plus you have the coupon. So, essentially they're getting about 40% of the capital within a year, and able to, what we've seen in several cases, fund those redemption requests. And I think the same thing happened with Blue Owl. They exceeded the 5% level and honored all those requests. I think it's the question of liquidity versus illiquidity. Is liquidity at a discount really liquidity if you're buying the public BDC? But there is a reason for, there's certainly concern, and the recent headlines have increased. I mean, direct lending is a finite market, so if more and more assets come in, obviously that's going to compress rates. It seems like assets may come out, so it may be a healthier market. And then, private credit as a whole, you also have asset-backed, structured finance and real estate credit. There's all kinds of other things that probably look more attractive currently, but we'll see.
Right. Thank you. Thank you, Steve. Just not to stay to pick on you for too long, but I do feel like there's been a big push towards, or a lot of interest in private investments recently, despite the challenging backdrop for, real estate and the interest rate backdrop. What do you think is driving that?
Well, it's a couple things. So we're seeing it more on the wealth space, right? Because it's a new ground for, these managers to raise assets. So it's certainly been a bigger push within wealth because you think about it, uh, prior to having defined contribution plans, when everyone had defined benefit plans, pension funds allocated significantly to private assets. I started my career a state pension for the employees of Montana, so we invested heavily in private equity. We're kind of early on in that stages, but now you're telling individuals to save for their own retirement, and you're taking a huge portion of the assets, investable assets, out of the mix. So you're not giving them full access to the asset classes. So I do think that individuals should have access to that. We're just kind of seeing, I think we're still kind of new on how the structures are going to work and what's best for individuals. So I think that's a giant push, but it's also, just the kind of standard public markets are shrinking. It's the Wilshire 5000 index is about 2,500 stocks because they can't find 5,000. Companies are staying private for longer. It just, and you get this greater and greater concentration in the S&P 500. If you want, to diversify outside of that, never mind returns, hopefully you're getting better returns for locking up your money too, but you're not really getting exposure to that smaller company, smaller part of the market. So I think that is also driving it. And, private credit, as we talked about, is a fairly new asset class since really kind of developed since the global financial crisis. So that just continues to grow on both the retail and institutional markets.
Thank you, Steve. Okay, so we've spoken a little bit about rates. Rates are on everyone's mind, so let's linger here for a little bit. It does seem like we are at an important juncture in terms of interest rates and Fed policy. We're due a new Fed chair soon, probably going to be quite dovish. King, I'd like to start with you. Do you think we're at the neutral policy rate yet? And where do you see the path of rates from here?
It's a good question. Interest rates drive everything, right? So I think it's also interesting about what transpired over the weekend about Powell's situation. I think overall, despite what transpired with the threats against the central bank over the weekend, overall the Fed is more accommodative. And let me define what accommodative means. I do think we're near a neutral rate. If we believe that the Fed follows the 2-year Treasury, then we probably have one more rate cut, maybe 25 basis points. I know there's some that are thinking 2 or 3. I don't think the economy needs 2 or 3 rate cuts. I think what's also important is the quantitative tightening ended last December. So if you recall, from June of 2022 to December of 2025, the Fed withdrew about $2.4 trillion in the economy. So that was quantitative tightening by all means. They've actually started to pump in money back into the system. Back in December, they pumped in about $40 billion into the system. This is important because the money supply right now is growing at around 4% year over year. Usually the money supply grows at around somewhere between 6 and 6.5%. So you actually need more money supply in order for the economy to keep going. So with that, I do think that the interest rate environment looks accommodative. At least the Fed's not trying to fight inflation. So I think right now it's not so much of interest rates and inflation, but really the focus for the Fed is going to be on jobs.
Thank you, King. Ken, what about you? Where do you see the path of interest rates, and how does this affect the way you think about portfolio construction?
I can't claim great expertise on predicting the number of cuts. I think the expectation is 2 cuts next year, so Fed funds goes down to about 3%. Should that happen, I don't think the long end would go down, though. Because inflation hasn't really gotten anywhere near the Fed's target. We had the 2.7 print this morning, and chances are they're going to take their eye off that ball because of the employment ball. The other a key thing about fixed income, though, is that even with rates having come off a bit from for where they've been, fixed income is still much more competitive to the stock market than it used to be. And so it's reasonable for allocators to have more in fixed income than they used to have. Though I wouldn't recommend being in credit right now, or particularly in high yield, because spreads are so tight.
Thank you, Ken. All right, let's talk a little bit about performance. One of the big stories we've heard recently is that how international, after all of these years, has finally outperformed domestic. So, Ken, I'll stay with you here. What do you think were the drivers of this outperformance, and what is your outlook here going forward?
Yeah, our firm has been sort of heavily tilted toward international for a while now, and so it really did pay off last year. Last year, in fact, the outperformance of non-U.S. equities versus U.S. equities was the largest it had been since 1993. So for more than 30 years, many of you probably weren't investing back then. Um, I, in part, I think that is because of the weakness of the dollar. So on average, the dollar index was up almost 10% last year. So that was a big boost to the dollar value of foreign securities. It's also, I mean, the earnings growth wasn't that much lower outside the US, and there's a big price earnings ratio advantage of non-US versus US. And so that's a key reason why, given that US international is already outperforming, it's outperforming and it has much better valuation metrics. It looks like a more favorable place to make equity investments than in the US stock market.
Right, thanks, Ken. And just to follow up to that, what would
Yeah.
you say, in your opinion, is the optimal balance between US versus international exposure?
Uh, Right now, for our clients, we're about 10% under. US is like 63% of the global equity cap weight index that includes emerging markets. And so we're probably like, we're still mostly US, like 53%. But in part, and we really don't like the US. It's definitely the worst positioned major equity market. But we also are conscious of benchmark risk. So that was kind of as far as we were willing to go. If we were less constrained, then I would think I'd want to not own the index in the US, maybe be more value oriented, but even have a bigger weight toward non-US.
Thank you, Ken. All right, sticking to the topic of performance, but now drilling down to the sector or industry level, we saw some pretty big divergences out there last year. Only three sectors outperformed the market. So, King, I'll direct this one to you. What do you think were the main catalysts for outperformance, and how do you see that changing this year?
Ultimately, it was all about earnings growth in 2025, and some would argue also multiple expansion. So, obviously technology was the best performing, followed by communications and industrials. And I think the communications and technology, they're so dominated by the Magnificent Seven names in those sectors, hence the reason for that outperformance. But a lot of it is driven by earnings growth. I know there's this dislike, if you would, of the overconcentration of the market in these largest companies. But if you look back and see where the largest earnings growth was, it was in these seven companies. The good thing is that the the other 493 stocks, the other sectors, if you would, are starting to come out of their earnings recessions. So you should start to see a broadening of the market, which is what we saw. I mean, or seeing at this moment in time. In terms of, I think, opportunities for other sectors this year, healthcare is one that we were underweight healthcare last year. Now we're equal weight to slightly overweight healthcare. The reason why is because it does have that earnings growth trajectory and reasonable valuations as well. I think it's also interesting, just as a final note, that the market right now is still um, preferring cyclical sectors than defensive sectors. So as of now, staples are still underperforming, utilities are still underperforming, real estate's been a laggard, still is a laggard. So we're seeing growth in the cyclical sectors, which in our opinion bodes well for the markets this year.
Thank you, King. Steve, do you have anything to add or anything you see differently there?
No, I agree. I think there's concern about the concentration, which there should be, right? You don't want to be that concentrated, but that's where those are the companies delivering the earnings growth, the revenue growth, and those are the companies that should be appreciating and performing. So I don't see a change to that this year. I mean, we can get into AI and is it a bubble and all that. I'm sure that's a topic we'll discuss, but for now, I don't see a major change in the growth of those companies, and I think those continue to lead the market.
Thank you, Steve. I mean, I think we should get into it. This question of AI being in a bubble is really the pièce de résistance of this entire discussion. So let's do it. I mean, Ken, King, Steve, all of you were managing money during the dot-com era. And today we're hearing a lot of talk about whether or not AI is in a bubble. So as we get into this, I think it's first and foremost helpful to define what we mean by a bubble. And so I'll start with you, Ken. How do you define a bubble? And when you look back at the dot-com era, what feels different and what feels similar today?
Yeah, it's the GMO definition of a bubble, which I go back to if I want to quantify it, is that the price is two standard deviations off trend, right? So you do some kind of long-term trend, and then if it's 2 years of 2 years of volatility above that, which we clearly are now, then we're in a bubble. You can also look at things like this Shiller Cape, and we're close to record highs on the Shiller Cape. Moreover, usually bubbles are not just identifiable by price action, but they're also identified by other behaviors that you can observe. The increases in borrowing, new era thinking, great enthusiasm for the newest stocks on the market, things like that. It was, my first big chief investment officer job was at Disney in the 1990s. So I was managing Disney's pension money during that time. And of course, the commentary in 1997, 1998, every year was these prices are crazy. It's never been as bad as this. This is worse than 1929. And so I'm not in charge of these assets, but I'm always thinking, like, is it dumb for me to own this stuff? What should I do about this? And I did do some things, but in retrospect, I thought, gosh, maybe I should have done more, because there was like several years of conversations about how crazy this is. Um, and so I've spent a lot of energy in those, the 25 years since, thinking about, well, what could I have done? How could I have known when to say, this is enough, well, let's get out. And to me, really, the aha was when I realized that it's just about the change in economic trajectory, that even that a bubble can last a while, and this bubble can last a while because the economy is still okay. But I will be watching, economic growth like a hawk, to just have that signal that we really should reduce our risk to the market. And if when that time happens, that is time to sell, I think it could be a rather significant change in prices, both for those stocks, but also for credit.
Thank you, Ken. Steve, what do you think?
That was a very detailed description. I don't think I have anything quite that quantitatively precise, but something that when stocks are at a level that they're never really going to hit that level again, even if they reach their full potential. So, off the dot-com boom, the Nasdaq sold off 80%. So that was clearly a bubble. I mean, I think things are going to be overvalued, undervalued, but just being overvalued doesn't necessarily mean it's bubble. It means kind of permanent destruction of capital, both from companies that shouldn't exist and companies that are quality companies that just never hit that again. Cisco Systems just reached a couple months ago, I believe, their high
Yep.
of 2000. So congratulations to them. But
Mhm.
that was a long 25 years if you're in the stock.
Yeah, you can lose a lot of money investing in great companies at the wrong time. I just did a video where I projected the next 10-year return for the S&P 500 index, and I came up with 3.4%. Not using crazy assumptions, just all I have to do is assume that price earnings ratios go halfway from where they are now to the long-term median. And I also assumed economic growth would be related to employment growth. It would be consistent with the economic growth. I'm sorry, the earnings growth and economic growth would align. And I get to 3.4%. And so if that is correct, and of course there's a wide range of uncertainty around that, then 10-year Treasury is a better deal.
Thank you. King, what do you say?
Yeah, I think there are some similarities, but I think there's actually a lot of differences as well. Um, the similarities, as Ken mentioned, is there's a lot of investor sentiment, a lot of investor excitement. There's strong returns in these stocks, these AI stocks. But I think that's about where the similarities end. We actually don't think we're in a bubble, AI bubble. And let me explain. I'll give you three reasons why. The first reason is that, in our opinion, firms are the smart money in general, right? So if you look at the recent acquisitions from big tech, especially in the last couple of months, it's an important tell because a lot of these deals were done in cash, not stock. So you had Alphabet buying Intersect Power for about 4.8 billion in cash, ServiceNow buying Artemis for about almost 8 billion in cash, Nvidia recently buying a company called Grok, G-R-O-Q, not G-R-O-K, for 20 billion in cash. SoftBank, I can go on and on. These are all cash acquisitions. In the dot-com bubble, we did not see that. A lot of these acquisitions from these very large, call it telecom, internet boom companies, were bought in stock. So AOL, for example, which is probably the poster child of what transpired during the dot-com bubble, AOL bought Time Warner for 180 billion in 100% in stock. So what the firms were basically telling us is that their stock was overvalued. So the recent acquisitions are a big tell that they're all done in cash. The second tell, I think, is companies are still buying back stock. So in 1999, if you look at the top 5 companies in the S&P 500, they were all issuing stock. They were increasing their shares outstanding. They were doing secondaries. We're not seeing the same activity. In fact, if you look at Nvidia, they just purchased 60 billion in stock last August. So they're continuing with their stock buybacks. The last thing I would say is the IPO activity. During the dot-com bubble and boom, if you would, it seemed like every week there were several companies going IPO in the internet space. If I look at the calendar today for this month, I don't even think there's one AI company going public. A lot of these are ETFs going public, issuing new funds, but I don't even think there's one like in the media say, oh, this company is going public. I don't see one on the IPO calendar. So I think it's different, in terms of the investor activity. That's not to say we won't be in a bubble AI in the AI eventually, but I think still we're sort of in the sort of middle innings at the most, if not the early innings of this AI trade.
Yeah, I think I mostly agree with that. And if you think about, these things take a lot of time to develop. You know, people thought markets were expensive in the mid 90s. So those of us that remember in 1996, December, Al Greenspan talked about irrational exuberance in stock markets. So if you'd chosen that spot to get out, you missed but more than a double from there. And in fact, the bottom of the market after the crash was still above that 1996 level. So it does take time to play out. And as Ken says, if there's not an economic impetus for a correction, but I just think the difference is we know about similarities, right? I think those are covered, but I think the difference is King alluded to, this is being funded with mostly cash. It's not just the acquisitions, it's the CapEx. I walking through the city to my office in the late 90s in San Francisco, every week a different competitive carrier was tearing up the streets and laying new fiber down, spending billions of dollars. They didn't have customers. They were simply issuing stock and getting credit, issuing high yield debt, getting credit from the vendors, and eventually, well, there was no one on these fiber networks. They were basically unutilized, and then the revenue never came through to support it. Whereas data centers, that capacity gets used as soon as it's built. It's getting paid for largely. You're starting to see more debt come in, which you should just from capital structure, but it's largely being funded by cash. And it's largely being paid for by, high quality investment grade companies that may, eventually will get built out, right? There'll be new technology. The chips will be 10 times better, use a tenth of the space and a tenth of the power, and all of a sudden we have enough data center capacity. But these companies doing the build outs are, I'd say, good for it, good for the cash.
I kind of agree on the IPO point, but I'm hearing talk of it. This could be a big IPO year. I don't know. I disagree vehemently on the share repurchase comment. If you look at the evidence about whether companies are good market timers, that is, or do they buy more of their stock when their stock's a good deal and they buy less of it? They're cyclical. Stock companies buy the most stock when they shouldn't. And that ends up levering the future results. It just makes the company more risky, right? By doing the share repurchases. The They have a lot of cash now, but the big AI investors are spending 70% of EBITDA on CapEx, which is a ratio that's rarely been reached in US stock market history. And it was reached though in the sort of the telecom bubble in the sort of 1990s that Steve was just referring to. So these are enormous investments. The dot-com or the AI companies are moving to negative free cash flow. And I don't think that we could say that these investments that are being made now will have a positive return on investment. Moreover, these big AI leaders are trading at PE ratios that are vastly higher than they sported when they were much smaller companies with much faster revenue and earnings growth.
Thank you. Wow, these differences of opinion make for such an interesting discussion. So I'm really loving this. I'm going to pivot now to the Q&A portion of this discussion because we've just had some excellent questions come through. And panelists, feel free to chip in wherever you see fit, but I'm going to direct this first question to King. As the US continues to step back from the global institutions that supported trade and economic stability, do you think we're entering a structurally different valuation regime? And if so, what does that imply for long-term metrics like PE multiples, price to book, or cap rates?
Oh, wow. I didn't think I was going to get that one.
Oh, sorry, Ken. I knew this was going to happen. Ken sounds very, very similar to King. I knew this was going to happen. King, this one's for you.
Okay.
Oh, thanks a lot. It's a little bit of a loaded question, I think. I think what the question is implying is that we had the tariff, the Liberation Day last April, and as I mentioned, the current administration threatening the independence of the Fed, if you would. So, given that, should multiples be lower? And should be much lower. So I would say theoretically speaking, yes, multiples should be lower given the increased perceived risk. There is that sort of what they call deglobalization discount as well, is that markets become more volatile when you need a higher compensation for risk. So theoretically speaking, I would say yes, the multiples should be lower. But the market's kind of shrugging this off, right? In terms of can multiples retrench a lot, it really depends. I think the makeup of the market's different too. Like, for example, for multiples to get back in line with much lower multiples, let's just say in the mid-century, for example, the makeup of the market's very different. When I first started my career in the mid-90s, energy was one of the largest sectors in the S&P 500. I think it was like 15% of the S&P 500, maybe 17% back in the mid-90s. And now today, the S&P, the energy sector is about 3%. So the makeup of the market is different. Today, you have a lot more capital light technology companies like a Microsoft or NVIDIA, which have higher margins, lower capital requirements. Therefore, their multiples are going to be higher, right? It's just sort of that, that's the way that a lot of these companies are valued. So, for multiples to go back a lot lower, it would mean that even these capital light companies are going to get revalued much lower. So I don't think it's going to be huge retrenchment in multiples. Will there be some mean reversion? There always is, in the markets. That's how markets work. But then at the same time, I do think there's opportunities here. This sort of dismantling of the global trade is, investors can focus more on domestic based US small cap stocks, right? And then that's the reason why maybe small cap stocks have been doing much better in the last couple of months. And then the losers may be things like, global multinationals, right? Where it depends more on trade. And there was a comment about why international is doing better. I think a lot of it has to do with just internal stimulus as well. If the US is not a good trading partner as it was in the past, well, then a lot of these countries have to do some of these, these products and services themselves. So that sort of reignites some internal stimulus inside the economy.
I just add to that. I think there's some headline fatigue here. So, when after Liberation Day, that was early on, everyone realized, well, 30% tariffs, multiples should be significantly lower. So they got lower in a hurry. And then you kind of kept getting some back off in that. So I think that, what we saw over the weekend, for example, uh, taken by itself should have a significant impact, right? If the Fed loses independence, which that's, the Fed independence is not guaranteed. It's legislation, so it can change. You would expect higher long-term interest rates, which would also put downward pressure on multiples. And I think the market would price that in, but I think there's some skepticism here of, how much is just headlines and how much is actually going to happen.
How important is Fed independence, do you think, Steve?
I don't know if that's my specialty, but it's important, right? The Fed was created because they got tired of going through market crashes, so that there was an independent body making policy, making monetary policy, and I think that's been a key to the strength of the dollar over the last 100 years. So, I would argue it's very important, and I think that the the stability of the currency and interest rates greatly benefit from it.
Thank you. Okay, this one's for Ken, Ken, Ken.
Thanks.
The equal weighted S&P has outperformed the market cap weighted S&P. And the question is this.
Not yet. The Capway ones beat. Go ahead. Sorry.
Okay, I'm just
Yeah.
the messenger. Here's the question.
Okay.
How do you balance having a strong conviction in an approach or index when you believe, sorry, let me start that again. How do you balance having a strong conviction in an approach or index you believe will outperform when performance is still being measured against a different benchmark?
Yeah, sorry, I stumped all over your question. I think the questioner was asking about how there's really been a remarkable difference in recent years, the last 4 years or so, between the performance of the cap-weighted S&P 500 and the equal-weighted uh, uh, S&P 500. So that is the index. S&P 500 index has done much better than the average stock in the index. I think last year S&P was like 18%. The average stock in the index was like 10%. But that's been going on year after year. And the questioner is asking, well, this seems to have gotten out of hand. And going forward, probably I'd prefer to buy the equal weight S&P 500, with a PE ratio of 19, than the cap weighted S&P 500 with a PE ratio of 26. And by the way, that gap, that 19 versus 26, I think is the biggest gap in all the data I have. as far back as Bloomberg has data for both those indices, the gap between the PE of the cap weighted being above the equal weighted has never been as big as it is now. And so you could reasonably say, well, oh, and if you look at those PEs on top of each other going back, 25 years, they're normally about the same. So equal weight, cap weight about the same. So this is extraordinary. So what I would advise the questioner is A, this can still carry on for a while. So yeah, I don't like to make a big shift unless it's starting to work, because it has carried on for several years that the cap weight has beat the equal weight. But for at Atlas, we've sort of taken a step toward equal weight. For our new investments in infotech, we're doing equal weight infotech instead of cap weight, because cap weight infotech is really just three companies, right? Apple, NVIDIA, and Microsoft. Do we take a baby step? The way that we try to manage these choices is we think about doing the best we can within a constraint on the amount of active risk we take versus our benchmark. We want to beat the benchmark, so we have to take some active risk, but we try to keep the active risk within, say, about 4%, thinking that we might get 1 or 2% per year extra for clients out of that. So we would never go wholly out of cap weight S&P and wholly into equal weight S&P, even though we think that's a good trade or will be a good trade soon. But we would nudge in that direction, but within a sort of active risk constraint.
Got it. Thank you, Ken. This next one is for King. Where are capital flows going right now across regions, asset classes, or styles? And what do you think is driving those shifts?
Yeah, it's a good question. I think it's going to surprise people that given the strength of the markets, that money markets are still the number one target of new capital flows, followed by government bonds and then equities in the third. And why is that? I think sentiment is still kind of skeptical, still skeptical about the AI trade, looking for bigger pullbacks in the markets. Honestly, aside from April of 2025, there really hasn't been any significant pullback in stocks. We're also seeing capital flows go into commodities, specifically in precious metals like gold, right? Gold has been the best performing asset class, was the best performing class last year. It's off to a good start this year, again. And finally, we talked about this already, international. I think overall, institutional investors, money managers like ourselves, are still underweight international. And the reason why they're underweight international is because over the last 10, 15 years, international stocks have delivered half of the returns of the US equities. So it's now started gaining a little bit of momentum, gaining a little bit of steam. And typically, as normal, investor behavior, even among professionals, is until you get a little bit of momentum, you kind of start to stay away from the asset class or underweight that asset class until it becomes much stronger. So we're starting to see, definitely more inflows into international than we've seen in the last couple of years.
Thank you, King. This next one is for Steve. Steve, will AI continue to weigh on the US economy in 2026 as heavily as it has in past years?
Yeah, I think, from our discussion, the consensus is here, at least. I know King agrees, Ken probably, it's to some extent, it's as long as it's continuing to go, there's not necessarily a sign that it's going to switch. So I think, CapEx is going to continue, and that's going to drive a lot of what happens within the U.S. economy, especially the tech sector. I think the thing we kind of maybe missed here is, and talking about equal weight, especially in tech, is that those concentrations in some of the AI companies are largely on the infrastructure side. Right? NVIDIA makes the chips, Broadcom's up there, and some of the hyperscalers building out data centers. I mean, as the technology develops, you have a shift from the infrastructure to the application providers, right? So same with the technology, the information superhighway technology, whatever you want to call it, like it was Cisco systems, it was JDS Uniphase. It was these companies creating, it was the picks and shovels, if you remember that. And ironically, Blackstone is advertising that again, so maybe that's an indication of a bubble. But everyone was after the picks and shovels, but the ones people that really benefited from the build out was actually companies being able to integrate, the internet in. So like Oracle, for example, did their web-based, it's that software as a service. So all those companies, Microsoft, Adobe, that converted their software from a license model to a service model benefited. And then, once you got to mobile internet, it wasn't the handset makers that benefited. It was it was Uber, because Uber couldn't be there without a handset, or DoorDash, or, all those companies. So that whole kind of sharing economy, scalable, I mean, the real beneficiaries are the application numbers. So I think this just kind of continues and rotates through different parts of the AI or the technology market, but I don't see a big shift in the actual infrastructure build out in 2026. So, as I say, eventually that will slow down. Um, but as far as the question goes, yes, 2026. But I would, back to the question of equal weighted, I think you do want to make sure you have exposure to all that and not just the concentration in the Mag 7.
Thank you, Steve. And here's a follow-up question for you, still related to AI, is as we enter this new phase where companies adopt AI and become more efficient, do you think that this will be a tailwind specifically for small cap stocks?
I think it will be a tailwind across the across the market, across the economy. Certainly, it smaller companies can certainly leverage AI. It's take a bigger piece of the operation costs out. It's certainly, that as the internet benefited smaller companies and startups and the whole venture ecosystem, I believe the same will happen with AI. I think it's that hard to predict exactly the time frame that happens on, but I think I think we're already started to see it happen. It'll continue to happen as this technology matures. But like with all technologies, it's overestimated in the short term and underestimated in the long term. So I think this is a long period we have ahead of us.
Thank you. Ken, this one's for you, Ken. Ken, when you get an indication that it's time to sell, what does a sale look like? How aggressively do you consider de-risking? And is it with cash, or is it just with lower volatility downside investments or lower downside investments?
Yeah, that's a good and difficult question. I mean, in essence, when it was time to sell, then you you want to reduce your exposure to the degree that reduction is comfortable for you. Like in the my context of an RIA, we typically just go down by 10% in equity. So that's not really a big adjustment. It's just an adjustment in the right direction. Like if for my own money, I would go down a lot more in equities, and our hedge. Uh, if you look at what university endowments did at prior uh, points of extremes in the markets, that Stanford University and Yale University did ultimately hedge, like go short the NASDAQ index around the end of the tech bubble, both to protect the public equity holdings in it, but also to protect the significant venture investments that had ridden up substantially. Right, they felt like those were at risk, and they certainly were at risk in retrospect. And before the global financial crisis, when credit spreads were about where they are right now, then some forward-thinking university endowments bet against credit. Basically, the trade be like short high yield and long treasuries, and that was a fantastic trade to have going into the global financial crisis. So I think when it's time to hedge, you either have to own less to your degree of of comfort in reducing exposure, or you need to enter into derivatives contracts to reduce your exposure. And I prefer just doing straight out uh, derivatives against the asset rather than doing options because of all the friction in options.
Thank you, Ken. All right, we've had so many great questions, and I wish we could have time for all of them. But I think just as we come up on the bottom of the hour and we're trying to wrap this up, I want to leave our audience with a bit of a parting gift and ask each of our panelists to think about what you think might be the biggest opportunity and the biggest risk to watch for investors in this coming year. Let's start with you, King.
I still think the biggest opportunity is in the AI trade. I still think we're early in that. I do think it's a game changer. I think it's, for holders of capital, I actually believe it's a wonderful opportunity because I think companies are going to become more profitable. I think profit margins are going to expand as companies implement more AI technologies into their operations. Good for investors, maybe not so good for the labor force, in general. In terms of the trade to avoid, was that the question? The trade to avoid?
Yeah, or the biggest risk you think investors should
Biggest
watch out
risk?
for.
Geopolitical risk, no question. I didn't used to have to follow posts and tweets all the time, but now we do. As professional money managers, we kind of have to see where the wind's blowing at any given moment. So I would say geopolitical risk is the one to watch out for, and probably the hardest, if you would, to figure out.
Right. Thank you, King. What about you, Steve?
Yeah, I think the greatest opportunity is in private markets because especially you have not seen the valuation expand like you have in public markets. But private equity still looks cheaper relative than public markets. So I think still like there's opportunity in there. You do get, AI exposure as you get diversified exposure, both in, I would probably stick with kind of middle market buyout and even the venture and growth. Not less excited probably about large market buyout. And I think there's an opportunity in real estate too. I mean, that market has been beaten up. It seems like it has started to recover. That expected to continue. Very low volatility and protection against potential public market volatility as well. As far as areas to avoid, yeah, I probably would have said interest rates and inflation prior to say a week ago, but I think that geopolitical risk is raising its head again. I mean, if you look at geopolitical events, they have very little impact on the market usually, but there's some out there, right? Does something carry over to China and Taiwan? That would certainly have massive impacts on the U.S. economy.
Thank you, Steve. And Ken, let's wrap a bow around this. What do you think?
Well, you can observe a bit of a different view of the outlook of AI stocks. At least, I think there'll be a correction sometime before, as this plays out. The nice thing about this market is the really rich valuations, these bubble valuations, are really identifiable and avoidable. And there's still plenty of stocks that you can buy with reasonable equity-like expected returns. And moreover, fixed income returns are decent. So a portfolio of value stocks and like investment grade corporate bonds will still provide a satisfactory return. And I've been thinking about downturns all my career, and what I would love to have at some point, although it would cost all of us money getting there, is an opportunity to have a big market correction where I can just back up the truck and buy a lot of credit and a lot of small and mid cap value stocks.
Thank you, Ken. All right, folks, that's all we have time for today. I'd like to say thank you again for joining us this afternoon. I'd like to extend a special thank you to our incredible panelists, Steve, Ken, King. Thank you for sharing your expertise. Thank you all and have a wonderful day.
Thank you.
Thanks.